How does a staggering 10.62% crash in the KOSPI and a massive 2,566-point drop in the Nikkei happen in a single brutal trading session? And how exactly did a newly listed Chinese company place itself at the absolute epicenter of this global financial earthquake? Hello everyone, welcome back to AI Market News. Today is July 28, 2026, a day when Asia's semiconductor sector experienced a violently historic sell-off. We are looking at market action that will require all of us to carefully reevaluate global tech portfolios. This isn't just a standard market correction. It is a fundamental repricing of who controls the technological future, and it is sending shockwaves from Tokyo all the way to Wall Street. Let's dive right into the core catalyst here. On Monday, China's largest stream memory manufacturer, CXMT, debuted on the Shanghai Stock Exchange. They executed Asia's largest IPO this year at roughly $9.8 billion. But it's the aftermath that truly shook the industry. On its very first day of trading, shares surged, giving the company an $800 billion valuation. To put that massive number into perspective, this instantly crowned it as China's most valuable listed company, effectively painting a giant target on the backs of established global players. Dream memory is the absolute lifeblood of everything from everyday smartphones to massive AI servers. So this huge new valuation signals that the market firmly believes a tectonic shift in supply is coming. The underlying mechanism behind this crash really just comes down to supply and demand. Historically, the global DRAM market operates as an oligopoly. That just means it is dominated by a very small number of producers, namely Samsung, SK hynix, and Micron. This tight-knit group relies on controlled supply to keep chip prices and therefore profit margins high. But when a state-backed giant like CXMT brings massive new chip supply into the global market, it completely shatters that control. It forces established companies into a brutal price war, putting severe pressure on their profit margins. And this existential threat to incumbent profitability was dramatically worsened by credible reports that a Chinese consortium has successfully begun manufacturing immersion DUV lithography equipment that effectively breaks the complex manufacturing monopoly long held by the Netherlands ASML. The result of this disruption was immediate and, frankly, devastating across Asian indices. As we can see in the chart, the Nikkei plunged 2,566 points, or 3.95%, closing at 62,365. This represents the worst single-day loss in 2 months for Japanese equities. Specific companies deeply entrenched in the semiconductor supply chain took incredibly severe hits. Memory manufacturer Kioxia hit the daily limit down, and semiconductor testing equipment maker Advantest dropped sharply. Investors rushed to liquidate positions as they frantically tried to price in this entirely new competitive landscape for Japanese manufacturers. Over in South Korea, the panic was even more pronounced. The KOSPI plunged an astonishing 10.62%. This systemic drop was so incredibly rapid that it actually triggered a market-halting circuit breaker. For anyone newer to market mechanics, a circuit breaker is just an automatic regulatory measure that temporarily halts all trading across an entire exchange. It is designed to prevent uncontrolled panic and allow all of us time to rationally digest new information. When trading finally resumed in Seoul, the damage was undeniable. Massive losses were sustained by the core incumbents, with Samsung Electronics falling up to 13% and SK hynix dropping over 11% in a single day. The aftershocks quickly reached Wall Street. The graph shows the US technology sector catching the exact same ripple effect, with the NASDAQ dropping 43 points to 24,932. This marks a fourth straight session decline for the tech-heavy index. And this downward momentum occurred right alongside 3 consecutive days of losses in the SOX Semiconductor Index. What we are witnessing is a significant capital flight out of high-valuation tech stocks. The broader market is actively reevaluating the long-term profitability of the entire global chip ecosystem, especially now that a massive new supplier has entered the fray with a nearly bottomless war chest. However, the broader macroeconomic landscape told a slightly different story. Contrasting the tech carnage, as we can see in the chart, the Dow Jones Industrial Average managed to rise 262 points to 52,210. This resilience in blue-chip traditional stocks was supported by entirely different factors. Specifically, based on available data, we saw easing geopolitical tensions with Iran and significantly lower crude oil prices. Lower energy costs help reduce inflationary pressures on traditional industrial and consumer businesses. That prompts a sector rotation, where capital flows out of risky tech and into these stable, value-oriented blue chips. Despite the Dow's gains, overall tension in the financial system remains highly elevated. This is visually captured by the VIX, often called the market's fear gauge, surging to 18.92.
This index measures expected volatility in the S&P 500 over the next 30 days. When it spikes like this, it directly reflects rising global anxiety and uncertainty among institutional traders. Meanwhile, the 10-year Treasury yield remained relatively stable at around 4.63%. Bond markets are essentially holding their breath, waiting for further direction from upcoming central bank meetings before making any major moves. For Japanese investors tracking these developments, the currency impact is a critical component of portfolio protection. The graph shows the USDJPY currency pair remaining surprisingly stable amidst the global tech sell-off, trading right near 163.93. Typically, during massive equity liquidations, capital rushes to safe haven assets like the yen, which would drive the currency's value up. But because U.S. Treasury yields remained perfectly stable, the interest rate differential between the U.S. and Japan kept the dollar firmly supported. This delicate balance prevented any wild, unpredictable currency swings that could have further damaged Japanese export stocks. Looking forward, based on available data, our economic calendar is absolutely packed with potential catalysts that could either soothe or exacerbate this market anxiety. Tonight, July 28th at 10 a.m. ET, we see the Consumer Confidence Index, which gives us a solid read on domestic spending power. Then, Wednesday, July 29th at 2 p.m. ET brings the crucial FOMC rate decision, dictating U.S. borrowing costs. Thursday, July 30th at 8:30 a.m. ET delivers Q2 GDP and PCE data, giving us the ultimate report card on inflation. Finally, Friday, July 31st features the Bank of Japan decision, which could dramatically impact the yen. Big tech earnings from Amazon and Microsoft, right alongside these massive central bank decisions, will ultimately determine if this tech sell-off is a temporary capitulation or a longer-term structural derating of the entire sector. The China semiconductor threat is no longer theoretical. It is actively forcing markets from Seoul to Wall Street to reprice competitive risk. With a massive wave of economic data and mega-cap earnings still ahead, all of us must stay nimble and prepared for elevated volatility this week. The defining question we must ask ourselves now is this: are we merely witnessing a temporary market panic, or is this the definitive end of a decades-long semiconductor monopoly? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.